Here's a truth that catches most investors off guard. Simply owning gold and silver doesn't automatically shield your wealth. The real question isn't whether you have exposure to precious metals. It's whether you have enough exposure to actually matter when the financial system faces genuine pressure. Walk through history's major currency crises and you'll notice a pattern. The individuals who believed they were adequately prepared often discovered they weren't. Their mistake wasn't choosing the wrong assets. They had either accumulated too little, held them in the wrong format, or fundamentally misread what these metals were designed to accomplish during periods of genuine financial strain. Right now, as we head deeper into the mid-2000s, this distinction carries weight. The economic landscape ahead isn't just another routine downturn. We're watching a fundamental restructuring unfold, one involving unprecedented debt burdens, currency instability, liquidity concerns, and eroding institutional trust. In this context, casual exposure to precious metals and genuine financial protection represent two entirely different things. Timing matters here, and not in the way most people think. Building a defensive position works only when you act before the danger becomes universally recognized. Once the broader population feels genuinely unsafe, the ability to position yourself effectively has already evaporated. Premium metals carry premium prices during panic. So the real question facing investors today isn't whether gold and silver will prove relevant in 2026. It's how much you actually need to own for it to make a tangible difference in your financial outcomes. There's an enormous chasm between holding metals as a symbolic gesture and holding them as functional protection. Most people discover this gap far too late. Before we can define what enough means, we need clarity on what gold and silver actually protect you from. These aren't miracle assets. They won't eliminate volatility from your portfolio, and they certainly don't remove all financial risk. What they do accomplish is preserve purchasing power when monetary systems face disruption, when policymakers commit serious errors, and when confidence in financial institutions erodes. Think of them as monetary insurance rather than growth investments, and like any insurance product, they only function effectively when sized appropriately relative to the risks they're meant to offset. The risk landscape heading into 2026 looks distinctly different from typical recession scenarios. This isn't simply about economic growth slowing or unemployment rising by a few percentage points. The fundamental issue centers on debt saturation colliding with intense political pressure on monetary authorities. Global governments carry debt burdens that cannot be serviced through traditional means. They require either persistent inflation or what economists call financial repression. Central banks find themselves trapped between defending currency values and supporting asset markets. Historical precedent shows that when forced into this corner, they consistently choose to support markets first. That choice carries profound consequences for anyone holding cash or fixed income. When real yields get suppressed, when currency purchasing power gradually erodes, and when financial assets become dependent on continued policy support, tangible monetary assets begin serving a fundamentally different function in portfolios. Gold becomes a credibility hedge against currency debasement. Silver functions as a hybrid hedge, responding both to monetary stress and to industrial demand dynamics. This dual nature explains why silver behaves so differently from gold during transition periods, and why holding one without properly understanding the other creates portfolio imbalances. One of the most damaging mistakes investors make involves thinking in generic percentages without context. They encounter popular rules of thumb suggesting 5% in gold or 10% in precious metals, then assume these figures apply universally. They don't. Proper allocation isn't about copying a model portfolio from a magazine or website. It's about matching your exposure to your specific risk profile. Someone carrying high leverage, minimal savings, and income entirely dependent on the financial sector needs a completely different allocation than someone with low debt, diversified income streams, and robust cash flow. Enough is relative to your situation, but it's not arbitrary. There are frameworks that work and frameworks that fail consistently. Another critical misunderstanding involves time horizons. Gold and silver don't protect you from daily price swings or weekly volatility. They protect you across complete economic cycles. Investors who panic and liquidate metals during temporary drawdowns are typically the same people who bought them for the wrong reasons in the first place. Protection assets feel uncomfortable to hold precisely when you're holding them correctly. They're not designed to make you feel wealthy during speculative bubbles. They're designed to ensure you're not financially destroyed when those bubbles inevitably deflate. Several structural pressures are converging as we approach 2026. Government refinancing needs are accelerating dramatically. Interest expense is consuming ever larger portions of national budgets. Political cycles are intensifying pressure on central banks to prioritize short-term growth and employment over long-term currency stability. Simultaneously, global confidence in traditional reserve currencies faces testing from sanctions, trade fragmentation, and geopolitical realignment. These aren't theoretical concerns debated in academic papers. They're already manifesting in policy decisions and observable market behavior. Central banks themselves signal this shift through their actions more than their public statements. Despite elevated gold prices, they continue accumulating physical metal, not because they anticipate immediate crisis, but because they're methodically reducing exposure to counterparty risk. When institutions that literally print currencies choose to hold an asset that cannot be printed, it communicates something significant about how they view future conditions. Individual investors would be wise to pay attention to that signal rather than dismissing it. Silver adds a distinct layer to this analysis. Unlike gold, silver gets consumed in industrial processes. It flows into energy infrastructure, electronics manufacturing, medical applications, and defense technologies. As industrial demand expands while supply remains constrained, silver's role as both a monetary asset and an industrial commodity creates volatility. That volatility cuts in both directions, which is precisely why position sizing matters even more critically for silver than for gold. The potential upside is larger, but so are the drawdowns during periods of industrial slowdown or speculative unwinding. So how do you actually think about enough in practical, actionable terms? You start by defining what exactly you're trying to protect. If your goal centers on preserving purchasing power through a sustained period of elevated inflation and currency weakness, gold tends to accomplish that more consistently across different scenarios. If your goal includes capturing optional upside from monetary stress combined with industrial scarcity dynamics, silver plays a larger role in the allocation, but neither metal should dominate your financial life to the point where you're exposed to unnecessary volatility or liquidity constraints that force poor decisions under pressure. Liquidity represents another frequently overlooked factor. Metals aren't as liquid as cash or publicly traded equities in all circumstances, particularly physical metals. That quality represents both their strength and their limitation. You never want to find yourself forced to sell protection assets during periods of stress just to cover short-term expenses or unexpected needs. This means metals should sit on top of an adequate emergency buffer, not replace it. Investors who skip this foundational step often end up liquidating their metals positions at precisely the worst possible moments. The 2026 question also involves sequence. The order in which events unfold carries enormous implications. Inflation may arrive in distinct waves rather than as a smooth curve. Policy responses typically lag behind market developments. Markets swing between complacency and panic, often with surprising speed. Gold and silver tend to respond differently at various stages of this process. Gold often leads during initial confidence shocks and sovereign risk concerns. Silver tends to accelerate later when liquidity expands aggressively and inflation becomes visible in everyday prices. Understanding this typical sequence helps prevent emotional decision-making when your metal's position appears to underperform temporarily. There's also a substantial psychological dimension to holding metals successfully. It requires genuine conviction because extended periods will pass where they appear to accomplish nothing while other assets outperform dramatically. That's the inherent cost of insurance. Investors who cannot tolerate that discomfort tend to abandon their positions right before those positions become genuinely valuable. This is why enough isn't merely a numerical calculation. It's an amount you can hold without constantly second-guessing yourself, without losing sleep, without feeling compelled to check prices daily. For some investors, enough means being able to cover 12 months of basic living expenses if their domestic currency weakens significantly. For others, it means protecting a defined portion of long-term savings from financial repression and negative real yields. There's no universal answer that applies to everyone, but there is a clearly wrong answer. That wrong answer is assuming minimal exposure will somehow scale up to provide adequate protection when stress actually arrives. It won't. Another mistake involves anchoring to nominal prices rather than real outcomes. Investors ask whether gold at a certain price level seems expensive without asking what that price represents, relative to money supply growth, debt accumulation, and actual purchasing power trends. In an environment where money gets created faster than goods and services, nominal prices lose interpretive meaning. What matters is what an asset can purchase over extended time periods. As we move closer to 2026, the margin for positioning error narrows. Adjusting allocation early proves far easier than adjusting under pressure. This doesn't mean making dramatic all-in moves or abandoning productive assets. It means being intentional and methodical rather than reactive and emotional. The investors who navigate transitions most successfully aren't the ones who predict every twist and turn perfectly. They're the ones who position conservatively and maintain flexibility across a wide range of possible outcomes. This is also why combining gold and silver thoughtfully matters so much. Gold provides stability and serves as a credibility anchor. Silver provides optionality and leverage to monetary stress dynamics. Used together intelligently, they can balance each other's characteristics. Used poorly, they amplify mistakes and create unnecessary volatility. The goal isn't maximizing potential returns, it's minimizing future regret. Now that we've established why the question of enough matters more than simply owning some gold or silver, we need to translate that conceptual understanding into practical frameworks that investors can actually implement. Because without structure, preparation devolves into guesswork, and guesswork is precisely what fails when genuine stress arrives. The first thing to understand clearly is that no universal allocation formula works for everyone. But there are ranges that have historically provided meaningful protection during periods of monetary stress, sustained inflation, and financial repression. These ranges emerge from studying actual outcomes rather than theoretical models. When we examine previous monetary transitions, including the 1970s inflationary cycle, emerging market currency crises, and periods of financial repression in developed economies, a pattern emerges. The individuals who preserved purchasing power weren't the ones with token exposure. They were the ones who had maintained a meaningful percentage of net worth in assets not directly tied to the financial system's stability. For most individuals, meaningful doesn't translate to extreme. It doesn't mean abandoning productive assets or betting everything on metals. What it means is allocating enough that the performance of those metals can effectively offset losses or stagnation elsewhere in the portfolio. Historically, that range has typically fallen between 10 and 25% of net worth in precious metals, depending heavily on individual circumstances. Factors like debt levels, income stability, and geographic exposure to specific policy regimes all influence where within that range an individual should position themselves. Below that range, metals tend to feel psychologically comforting, but remain financially irrelevant when stress actually arrives. Above that range, volatility and liquidity constraints can become genuinely problematic, especially for those who rely on their portfolio for regular cash flow or near-term expenses. Within that broader allocation range, the balance between gold and silver carries significant implications. Gold tends to serve as the anchor. It's less volatile, more liquid globally, and more directly tied to monetary credibility concerns. Silver, by contrast, displays higher volatility and greater sensitivity to both industrial cycles and speculative flows. Because of these characteristics, gold typically plays the preservation role while silver plays the amplification role. This doesn't mean silver is inherently riskier in all contexts, but it does mean its price swings register larger in both directions. For many investors, a gold-heavy allocation within their metals exposure provides stability, while a smaller but still meaningful allocation to silver provides optional upside if monetary stress escalates beyond current expectations. A common framework used by conservative allocators involves roughly 2/3 gold and 1/3 silver within the precious metals portion of their portfolio. This balance has historically reduced overall volatility while still allowing participation in silver's upside during periods of inflationary pressure or supply stress. More aggressive allocators might tilt closer to a 50-50 split, but that comes with the explicit understanding that drawdowns will be sharper and patience will be tested more severely. The key isn't maximizing potential returns. It's aligning exposure with personal temperament, because the best allocation on paper becomes useless if you abandon it under pressure. Another critical factor involves form of ownership. Physical metals behave fundamentally differently from paper representations. This distinction becomes progressively more important as systemic stress increases. Physical gold and silver eliminate counterparty risk, but introduce considerations around storage, insurance, and liquidity. Paper instruments offer convenience and immediate liquidity, but rely entirely on the stability of the financial system that issues them. Many investors underestimate how dramatically these differences matter until circumstances make them impossible to ignore. In environments where institutional trust erodes, the value of direct ownership becomes starkly apparent. But this doesn't mean all exposure must be physical. A layered approach combining physical holdings with carefully selected financial instruments can provide practical balance. The optimal mix depends on individual circumstances and risk assessments. It's also important to think in terms of function rather than abstract labels. Ask yourself what role each portion of your allocation is meant to play. Is it meant to preserve purchasing power over multiple decades? Is it meant to provide optional liquidity during acute crisis? Is it meant to hedge currency risk, geopolitical risk, or policy risk? When you answer these questions honestly, the appropriate size and structure of your metals allocation becomes substantially clearer. Without this clarity, investors often chase performance rather than protection, which leads to poor timing and emotional decision-making. The 2026 timeframe adds particular urgency to this analysis because many pressures building today are cumulative rather than cyclical. Debt levels aren't expected to decline meaningfully. Demographic pressures are increasing entitlement costs across developed economies. Political incentives consistently favor short-term stability over long-term fiscal discipline. These forces strongly suggest that policy responses will continue favoring inflation and financial repression, rather than painful austerity measures. In such an environment, assets dependent on policy credibility become progressively riskier, while assets existing outside the policy framework become more valuable as hedges. One of the most underappreciated risks heading into 2026 involves the erosion of real returns. Even if nominal asset prices rise, inflation-adjusted outcomes may deeply disappoint investors. This proves particularly dangerous for savers who rely heavily on traditional fixed income instruments or cash-heavy portfolios. Gold and silver don't produce yield, but they can effectively protect purchasing power when yields get artificially suppressed below inflation rates. In a world where real yields remain negative or unstable for extended periods, the opportunity cost of holding metals decreases substantially, even if nominal interest rates appear superficially attractive. Another scenario to consider seriously involves volatility clustering. Extended periods of calm often directly precede periods of intense instability. Markets consistently underestimate how rapidly conditions can shift. Gold and silver often respond not to gradual changes, but to sudden collective realizations. This is why waiting for confirmation can prove extremely costly. By the time the need for protection becomes obvious to everyone, the price of that protection has typically increased dramatically. Preparing gradually rather than reactively reduces both financial cost and emotional stress. There's also a geopolitical dimension that cannot be ignored. Fragmentation of trade relationships, emergence of currency blocks, and restructuring of payment systems all increase the value of neutral reserve assets that don't carry political baggage. Central banks have already responded to this reality by systematically increasing gold holdings, not because they anticipate immediate collapse, but because they're methodically reducing dependence on assets that carry embedded political risk. Individual investors face similar considerations, though at a smaller scale. Diversifying away from dependence on any single system or jurisdiction reduces vulnerability to policy decisions beyond your control. Another common mistake involves treating metals as a trade rather than a position. Trading requires precise timing, strict discipline, and exceptional emotional resilience. Positioning requires patience and clarity about objectives. Investors who constantly adjust their metals exposure based on short-term price movements typically achieve worse outcomes than those who establish a thoughtful allocation and rebalance only occasionally. The goal isn't to outsmart the market on every twist and turn. It's to remain solvent and flexible across a wide range of possible outcomes. Rebalancing itself represents an important but frequently neglected discipline. As metals perform well relative to other assets, their share of a portfolio naturally increases. At that point, trimming the position and reallocating proceeds can reduce risk without abandoning the protective function. Conversely, during periods when metals underperform other assets, adding modestly can restore desired balance. This systematic approach removes emotion from the process and aligns behavior with long-term objectives rather than short-term market noise. For those worried about starting too late, it's important to remember that preparation isn't binary. Being partially prepared proves substantially better than being completely unprepared. The worst position is paralysis, driven by perfectionism. Markets don't require perfection from investors, they reward prudence. Spreading adjustments over time reduces timing risk and psychological burden significantly. It's also worth addressing the social aspect of this topic directly. Discussions about gold and silver often attract extreme viewpoints, ranging from complete dismissal to obsessive doom-mongering. Neither extreme proves helpful. Metals are tools, not tribal identities. They're components of a broader strategy, not replacements for thoughtful financial planning. Maintaining that balanced perspective prevents emotional overinvestment and subsequent disappointment. As 2026 approaches, the question isn't whether the financial system will continue functioning. It's how it will function and who it will favor when stress intensifies. Systems under pressure tend to favor debtors, large institutions, and those closest to policy levers. Savers and wage earners typically bear the adjustment costs. Gold and silver provide a mechanism to opt out of that dynamic to a meaningful degree, but only if held in sufficient quantity to actually matter in your personal financial outcomes. Ultimately, enough represents the amount that allows you to sleep soundly at night while remaining financially flexible during the day. It's the amount that would meaningfully offset a significant decline in purchasing power without forcing you to sacrifice liquidity or opportunity elsewhere. It's not a number someone else can give you from a book or video. It's a range you arrive at through honest assessment of your specific risks, goals, and temperament. The most important takeaway is this: preparation isn't about predicting disaster with precision. It's about acknowledging uncertainty and positioning accordingly. Gold and silver aren't bets on systemic collapse. They're acknowledgments of fundamental limits, limits to sustainable debt accumulation, limits to unlimited policy flexibility, limits to institutional trust. As those limits become progressively more visible to mainstream investors, the role of tangible monetary assets becomes clearer and more valuable. If you've been focused exclusively on silver's daily price movements or gold's headline coverage, this broader strategic perspective becomes essential. The real question isn't what metals will do next week or next month. It's whether your financial structure is resilient enough to handle multiple scenarios without forcing reactive decisions under pressure. That's what enough truly means in practice. As we move toward 2026, the investors who navigate this period most successfully won't be the ones who guessed every development perfectly. They'll be the ones who position themselves thoughtfully, size their exposure appropriately, and maintain discipline when emotions ran high. Gold and silver serve as tools for that discipline. They're not shortcuts to wealth or substitutes for careful planning. Used wisely, they can provide genuine stability in an unstable world. Used carelessly, they become just another source of stress and poor decision-making. The window to think clearly about these issues always exists before urgency takes over. That window remains open right now, but it doesn't stay open indefinitely. Preparing while conditions remain relatively calm proves far easier than scrambling when they deteriorate. The goal isn't to be alarmist or to spread fear. It's to be realistic about the environment we're entering and to position accordingly while we still have the luxury of time and choice.